Hello, welcome to another episode of Talking Tax with Alex. Haven't done an episode in a while. I got to do something a little bit different this time, and I'm going to do a little bit more of an educational series. It's just going to be two parts, but it's going to be hopefully about something that is relatively pertinent. At least it is in Southern California. We're going to be talking about investing in real estate partnerships and all the hurdles and all the laws related to taking losses in those partnerships. So I'll quickly talk about what this series is about. I kind of just did on the intro, but we'll talk a little bit more about it. What we'll cover on each video. So like I said, there's going to be two parts. The first part, we're going to talk about something called substantial economic effect. And then we're going to talk about other various loss limitations. And then I'll just wrap it up with some real estate partnership tax tips, stuff that I've seen in my practice and that I think you should know. So this series is about how to plan for losses from a real estate partnership. So if you don't know, or if you're watching this video, you've not invested into a real estate partnership, or maybe you're just thinking about it and you heard people say, oh, you can invest in real estate and it's really good for tax reasons, and you don't know what those tax reasons are, that's what this video is going to talk about. The tax reasons are that real estate typically kicks out losses, and those are losses on your tax return through depreciation. However, usually if you have a good real estate deal, or after a while, it becomes cash flow positive. So you're not paying taxes because you're covered by depreciation. That's an ideal world. That's why everyone wants to go into real estate. Obviously, it just depends. If you don't have tenants for your rentals, whatever. There's a lot of things that can happen. So let's not, get hung up too much on that. But that's what people say when they say, "Oh, invest in real estate. It's really good for tax purposes." That's what they're talking about. So I'm just going to set the stage, set up an example here for our real estate partnership. We're just going to assume here, Aaron and Brittany, they invest in a real estate investment LLC. Aaron puts in $55,000 of cash. Brittany puts $495,000 of cash for the ownership split you see here. Aaron owns 10%, Brittany owns 90%. So they use this money in the partnership to put $550,000 down payment on a building for $2,750,000 rental building, and they secured it with, or they got a mortgage on that building, secured it for $2.2 million. Okay, so the numbers here are set up to make the example easier because I just want to talk about concepts. I'm hopefully not going to go too far off the path here. I just want to talk about concepts and deducting losses. We're not going to be talking about partnerships per se, other than the rules that govern partnership losses. So I guess, we are talking about partnerships, but it's going to be very narrow here. So more about this example with Aaron and Brittany is that we're just going to assume, and I know this isn't real, but the entire amount, the 2.7 million, is for building. There was no land. This just makes the math a little bit easier. We're going to assume that it's break even. Rental revenue covers all expenses, including the mortgage, but that the building, the useful life of the building, this makers is residential, is 27 and a half years. That means depreciation expense is $100,000 a year. So that's the loss that is going up to Brittany and Aaron. So the question before us is, can Aaron or Brittany deduct their share of $100,000 of depreciation expense? That is the tax advantage. That is like why people want to invest in real estate, because you get to write off depreciation. It's a big deal. It's $100,000 on this investment. That's one of the reasons why a lot of people want to invest in real estate. So the question that we're covering on this video is, can they deduct that depreciation expense? I'm going to take you through a couple different things that you have to think about in partnerships, and hopefully this is enlightening for you. So we're going to talk about substantial economic effect. So there's a couple things where you can allocate, in a partnership, you can allocate profits and losses however you want. The partnership agreement says that you can do that. But there's a couple things you have to keep in mind. You have to have substantial economic effect. What does that mean? That means you must maintain capital accounts you have to have a liquidating distributions equal to those capital accounts at the end. So when liquidating distribution means the partnership is all done, that the money each partner gets is equal to whatever their capital accounts are. Capital accounts we're not going to cover. Just know that it's a requirement. Excuse me. And the negative capital accounts must be restored upon liquidation. So this is a big one because this basically means that you can allocate profits and losses however you want. Aaron and Brittany, although they are 10% and 90% owners respectively, the partnership agreement can say the first $500,000 of losses can go to Aaron and zero goes to Brittany until Aaron gets 500,000, then Brittany gets, then they split it 50-50. Let's just say something like that, right? The math is not 90%, 10%, but you're not bound to that. You're bound to maintaining capital accounts. There must be liquidating distributions when the partnership's over, and negative capital accounts restored upon liquidation. So that's where like partnerships, they can get really creative in allocating losses. Like Aaron could want to do this deal maybe because he gets $500,000 of losses allocated to him in the first 3 years, for tax purposes, whatever. As long as the partnership agreement has these clauses, then he's allowed to do that. But the catch is, if he over allocates and he has too many losses, that's what a negative capital account would do. You have too many losses and the partnership kind of winds up. He's got to put that money back in. So you can't tip or balance the allocations forever. That's what this means. So planning, just a key planning tip around this is you have to have an attorney familiar with partnerships to draft an operating agreement with this language. Like, you have to. That's just the law for partnerships. You're also going to want a tax advisor that's familiar with economic effect requirements, allocations, all that stuff. Real estate deals can get very creative. There could be waterfalls, based on, investor levels. There's a lot of things that can happen. So you're going to want a tax advisor, CPA, that is familiar with doing these kind of deals, like me. There's also various loss limitations. So this this item's a little bit more statutory driven, but there's just a couple things that you have to be aware of. So, for example, capital loss netting rules and the loss limitations. So capital losses net against capital gains, and then you're limited on your capital losses per year. So either you have a capital loss carry forward and you can take $3,000 per year as ordinary loss, or you have to net it against your capital gains. So there's some extra rules here. So if you happen to buy a building and you lose money on it, you might not be able to take that whole loss in the year that you sold the building at a loss. Got to think about that kind of stuff, or pay somebody to think about that stuff for you. There's Section 179 expense limitations. So Section 179 isn't super popular right now, but because there's bonus depreciation, which is on its way of phasing out. So Section 179 might come back into light pretty soon, and these losses are limited by there's a separate set of rules. I'm not going to go too far into it, but they are limited by code, and they're limited by the income of the business. They're limited by income of the business, how much assets you purchase in the business, that kind of stuff. I don't quite know all the Section 179 limitations off the top of my head, but those are the big ones. And so these are limited on your K1. And so if you're expecting a big loss and you bought a bunch of improvements to your restaurant or whatever, and you took 179 expense on it, you might not be able to take them. Charitable contributions, again, if you have a real estate or two and they have a charity event or whatever, and you're expecting $100,000 of charitable contributions to be deductible, and they come through, they're going to be limited on your 1040 to your AGI. That percentage keeps changing. It's like 50%. It went up to 60 during COVID, 100% actually. It keeps changing, but it's about 50% normally of your AGI. Or if you donated appreciated assets, you donated the building perhaps, there's going to be other sets of limitations that's going to come through on your personal return. So you might not be able to take it on your personal return. And this is brand new in 2022. It was introduced in 2018. They got suspended during COVID and came back in 2022 filing. They're called the excess business loss limitation, where you can only take losses in a business of up to 500,000 for married couples, and then the rest carry forward. So if you bought a really large building and you're expecting $1 million loss, you might not be able to take all of it. It's just going to be limited. And planning tips is you want to have a tax advisor that's familiar with all these current tax provisions, like me. So that's it for this episode. We're only going to cover those two topics. There's two more that I want to cover. Like I said, this is a two-parter. I think it's really important to check before you invest. So talk to your tax professional. If you don't have a tax professional that's proficient in real estate, maybe you want to find one. Find one, get familiar with them. Maybe talk to them, pick their brain. There's a lot that goes on with real estate. And then your real estate deductions are not guaranteed. That's the point of this video. I think it's, if you're talking to somebody and they're saying, yeah, you're just going to get all these losses and it's going to offset all your wages and you're not going to have to pay any tax. That's not necessarily true. There's a couple limitations there that you might not be able to take those losses until a future event. So you want to consult your tax advisor. That's it for this video. If you like this content, please like the video, subscribe to the channel, and comment or email me your thoughts. Thank you. Bye-bye.